We are the hub for news, results, and CEO interviews focusing the junior commodities sector. We provide market analysis and perspective that will help position you for solid returns.
Good morning, everyone. Welcome to the show. Welcome to Stock Talk. It's the market mindset here where we look at current events and kind of translate it for people and give our perspective on it. Austin, we're jumping into the obvious big one, bank collapses that are continuing and the domino effect, what could come of it. Let's start with SVB, Signature Bank, as well as Silvergate.
Yeah, it's the great big totally not a bailout, which is always lots of fun. Obviously, for anyone kind of that follows the financial sector or the business world at all, you've heard about the meltdown of Silicon Valley Bank, largest bank failure in the U.S. since 2008. So that gives positive vibes. We love that. But the Fed stepped in and took over ownership of the bank on Friday after something like to nearly $42 billion were withdrawn in a single day. They had massive amount of assets that had to be backstopped. The FDIC had to invoke the systemic risk exemption. So really a big kind of meltdown, and we're really not even sure yet what the entire knock-on effect of this is going to be.
Yeah, and so there's a lot to kind of break down here. I mean, this is the largest bank failure, or second largest, since Washington Mutual Bank back in 2008. Now, that's this Silicon Bank is they call it like their bank. It's like all the tech FANG, all of the venture cap, private equity. It's kind of their bank. It's been around for about 40 years. It had $209 billion in assets, and it according to the website, it said it banked nearly half of all U.S. venture-backed startups and 44% of the U.S. venture-backed tech and healthcare companies that went public in 2022.
Yeah, it's a massive amount of companies that were involved. If you go down the list and looking at, who's in there, there's names that will jump out to anyone. One that stuck out to me was Roku, like the TV app. They had an account in there with over $450 million in it in one account. Now, like, if I'm the CEO of that company, should be seriously looked at. What the hell are you doing keeping $450 million in one regional bank in the U.S.? But it's crazy the kind of involvement that it was, and maybe that's a knock-on effect. You can sort of see, okay, well, that's why so many different, major groups are drawn to it. I know we're going to talk about Sweden's largest pension fund had a large amount of money involved with them. We're going to talk about Goldman Sachs were largely involved as well. So really kind of interesting collapse. Like you're kind of saying, this was their bank, if you want to kind of put it that way.
And it's good to make a distinction between a commercial bank, which this is, compared to an investment bank. A lot of people remember like Lehman Brothers and Bear Stearns. Those are the big bank names that people remember from the 2008 meltdown. Those are investment banks. People don't know Washington Mutual as much because it was commercial. The big investment banks were the ones that people really kind of paid attention to. But like Lehman's was 619 billion in debts. Yeah. So it was the largest corporate bankruptcy, and it was bought by Barclays and Nomura Holdings back then. But also, to put this into perspective, like you said, it's a very unique bank, this bank, and you'll get into some of the regulations. This isn't just your everyday regional bank in the US or like TD Bank or CIBC, where the average account size is a lot less because you deal with just the general public. This is like, it was the bank for the ultra tech FANG wealthy.
Yeah, I mean, the secret isn't really a secret. It's right in the name, Silicon Valley Bank. It's exactly what you think it would be, right? But and maybe that's a reason why it was so quick that this bailout, not a bailout, was this action was taken. And we'll just jump in quickly for people who don't know much about it. Is the FDIC had to use the systemic risk exemption, which allows them to insure over their normal maximum threshold, which is only $250,000, is what's normally insured by the feds. Now, what would happen in a situation like this where they don't jump in and backstop the entire, portfolio of the bank? They would sell off the assets and then redistribute that to try to cover everyone's account. Now, someone did the math on this, and it works out to somewhere between a 10 to 15% haircut for kind of everyone who had their money in the banks. But I mean, even for example, I'll go back to Roku, who had $450 million in the one account. 10 to 15% of that isn't a tiny chunk of change. So
No.
so the Fed's stepping in. Obviously, they kind of had to, but the way that they're selling this, it's very similar to the whole we're not in a recession,
Yeah.
so we're not having a bailout.
Well, yes, it's unfortunate. There's a lot of politics involved in this as well, and we're going to try to stay somewhat out of it because it's ugly out there what we're seeing in articles. But and also to put some perspective, 500 federal insured banks have failed from 2008 to 2015 in the U.S.
Yeah,
That's
an astonishing number.
Something that I looked into. It is shocking, but once again, this is the bank of banks to the the extremely highly elite, I guess you'd say. And that brings a highlight because that's the crowd, the woke crowd, the extreme left that has been, kind of dictating free speech, dictating all these things, spying, you name it. That's why this has become so political. Is that it's a lot of people that people don't like. Let's just say, or love.
Yeah, and I mean, like, there's no shortage of names on the list of. I mean, like, Fidelity, Morgan Stanley, BlackRock are all very exposed to Silicon Valley Bank. HSBC, I believe, owns their UK arm, and then you had Goldman Sachs had stepped in to buy their bond portfolio as well. So these aren't, I've listed a bunch of names there, and that your average kind of person not a fan of any of those groups or funds that I just mentioned.
No, and I mean, let's just take a quick peek because people say, well, what happened here? And it was a bank run. People were taking their money out faster than they could possibly supply, and that brings into people's mindset. Well, can't I just go take out any amount of money from my bank account? Which is a no, and also that there isn't really a lot of money in your bank, and that's Canada, U.S. anyway. Like if you go and say, I want to pull out $5 million from my bank account, it's not going to happen. They don't have the cash. They don't keep it at the bank. So our system is moved in a certain specific way that it's electronic. It's not actual cash. If you try to physically go to the bank, it's not going to happen. But really, to break down what happened as simple as possible is that, and this is the part that's going to need a lot of investigation, is SVB plowed billions into long-term U.S. government bonds, basically when there was zero interest rates. So when they're giving free money to all these companies, and that wasn't just you and me. I always kind of joke around, if I had a son in the future, he goes, Daddy, what were you doing when they were giving away money for free? Zero rates out there, almost nothing.
Yeah.
They were going the other way and saying, let's buy long-term debt at zero. So someone has to ask the question as to who is in charge of risk management. Well, we know, and also the bonds and this strategy of trying to mitigate risk. And once people realized that there was this mismatch, and of course rates went against them, that's a massive. They would have to execute some of these trades in order to take the loss, get the cash, and make a payment to a client. So let's kind of go into a little bit as to what happened with that.
Yeah, well, I mean, the analogy that I'll use, imagine going to the casino and you've got the money to go and gamble, and whatever you win, you're going to get to keep, and whatever you lose, the government's gonna pay for. It's a dangerous precedent that's being set.
And okay, so one of the first people to kind of put out a warning that I know was Peter Thiel. The Peter Thiel's Founders Fund put out a warning back, I think it was a couple of weeks back. And that also helped people to make a bit of a run on the bank. There's also some claims that there was some internal dialogue, WhatsApp, Telegram, lots of emails apparently telling people make a run for it. In fact, we have this one article, and not that we're picking on this Entree Capital, but there's this article in Calistec, and it just says, "Don't ask questions, just withdraw the money now." So you see people knowing, remove the money, take as much out as you can, make the run because they either had either just looked at the mismatch, or there's speculation because the CEO, a lot of management were selling stock as well of this, and that's important to know who that person is, and because it's one of the it brings up questions. So let's just kind of mention that, the CEO was Greg Becker, and he was also director at the Federal Reserve Bank of San Francisco. So it brings the question of he didn't know that rates were going to be moving up, or that they had been moving up. So it's, and I'll throw in the other person here, and I feel bad because he's either completely incompetent or one of the unluckiest people ever to be born, is Joseph Gentile, who previous to this, one of his big roles was at Lehman Brothers before it failed. And his job was, he was the fixed income person. So this wasn't like a rocket science kind of exposure. This wasn't complex. It wasn't difficult to understand. It's like basic type of risk that when we go through it, it'll be like the FTX when they came out and said, there isn't some elaborate, ingenious fraud here. This is just simple fraud. It's very basic. And I think they're going to find that this is basically the same. There isn't something complex like Enron, where it took like forensic accountants to come in and pull apart the dynamic derivative trading and the elaborate, kind of mystique that people had of some of these investment bankers that were able to kind of create these products and move money around. This is not that.
No, it's an incredible level of incompetence that is just that continues to be shown, and like you mentioned, different examples. But that's what's out there now. What we're looking at now is, are we in the early kind of stages of a contraction cycle? Yeah. And what is the kind of leveraged assets? How is that going to move long term? And what is this failure going to lead to? Is it going to cause a lot more problems down the road? What is the fallout from this is going to be really critical to watch. And how, if this level of incompetence was going on here, who else has been this massively incompetent? Which it wouldn't surprise me if there was a lot of names on that list.
Well, this is, I'm not going to make some friends now, but this is what you get when you go with not merit. You go with quotas, and you go with politics and propaganda to run your companies. So this whole ESG DEI push if it's that quote, "Go woke, go broke." You're going to see a lot of these woke companies. If you want to short some companies, it's not something we do. There's a great list of ones that one could look at, because if you're not hiring the best and smartest and brightest, especially for exceptionally difficult jobs, you expect a lot more of this. Now, that's a topic all unto itself, and we kind of want to leave that alone because it does anger a lot of people that are, extreme left progressive types. But we focus just more on the economic part. What's interesting, though, is that Signature Bank failed as well. And I think on the one day, $10 billion was taken out quite quickly. It had 40 branches and assets of $110 billion, making it the third largest bank to fail. And to throw things in to the mix that's interesting, that goes down the conspiracy kind of tangent quickly, is Silvergate. So Silvergate was more of a crypto bank, and it had very strong ties to FTX. It's part of the domino effect of its failure, and it's been allowed to fail, but it's been allowed to fail. Like, it's done.
Yeah, they're not jumping in to provide the same level of support there. And FTX was actually one of their largest clients at Silvergate as well.
Silvergate is getting no support. And so, of course, anyone who's crypto is screaming, well, they want to punish crypto, and they don't want, they're helping this other position out. And once again, let's put some perspective on this. I'm going to be very fair, because it is not an easy decision to bail, and they have bailed them out. Let's be honest. Now, someone who can make the argument, say, well, they didn't bail them out because they allowed the equity position, or the equity trading portion of the company, to fail. Well, the market cap of SVB was $6 billion. The market cap of Signature Bank was $4 billion. So to save both of those entirely, like as a bailout, that's $10 billion. Well, they've gone ahead and guaranteed $151 billion for the uninsured assets of just of SVB on its own. So now SVB is not unlike FTX, huge political donations, very big into woke policy. They're pushing all of that kind of propaganda. They're known for it. It's a big cause of theirs. So one has to wonder with who's on the board. So if you look at the board, their career, their past, their initiatives, what they're working on, who they are. People are asking, oh, well, who's going to go to jail for this? Because there's lots of, let's just say, emails, selling of stock, everything else. No one's getting in trouble for this. I'll go stand out and kind of put myself out there. No one got in trouble in 2008, except for one poor fella that I don't even remember who it was, who had almost nothing to do with anything. So I don't see anyone getting in trouble, which highlights, we talk a little bit about the level of corruption that's out there today. No one's getting in trouble for this. No one's getting in trouble for the stuff that's right out in your face today. So this one, will go on forever until people forget. And the flip side of this argument of should you or shouldn't you bail them out is, I don't like this crowd, like in the least. But at this point, I would agree that the bailing them out, the 151 billion, you do it because this is the crowd that, as much as I have extreme dislike for their behaviors, their politics, their beliefs, they drive innovation. So that's a lot of money, specifically private equity, venture fund that's driving technology. They're destroying energy right now. Do you really want them also then destroy the tech sector? And I would say, no. This is a bailout that I would say is smart. They're going to investigate the management. We'll see what happens with them. But and I'm just being speculative and maybe a little bit controversial by saying nothing will happen. But I think it's a pretty safe bet. But overall, once again, not making a lot of friends on, one would say, my side of things. I think it's a smart play to do. You've already printed trillions anyway for your cause. What's 151 billion at this point?
Yeah, and I think that's a good point as well, because if you look further down the kind of, like, if you look past some of the big names, there's a lot of smaller tech startups and stuff who are really kind of pushing the forefront of innovation and new ideas and like clean tech, green tech, all that sort of stuff that really don't have any of this big kind of woke identity politics background. They're just a tech startup that's just, this was the bank to go to, right? It was sold as one of the safest options, certainly as far as tech goes for banking. It was arguably the safest option. Well, maybe let that tie it into why the heck did Sweden's largest pension fund have over $1 billion invested with them, is a question that I think needs to be kind of looked at. But if that's the way it's being sold, you can see that as a smart investment for a Swedish pension fund to say, hey, look at this American bank that's got this great list of clients of companies that we all recognize the names of. That seems like a safe bet. We should put our money there, right? So on paper, at least, that it's a move that kind of makes sense. But my God, that's a disaster for the Sweden's largest pension fund, Alecta.
Yeah,
I believe it
I think
is.
it's $1 billion that they've lost to date or something. Yes. But so we'll follow up on that as well. But it does beg the question, like, what was the thought? What was the plan? Why is this? And you touched on it before, like, as far as cycles and what does this mean? Ray Dalio has an excellent post in LinkedIn today. And I'm always a big fan of some people like Peter Thiel. Ray Dalio is certainly I'm a fan of. And it doesn't mean that he's always right, but his kind of take was that we're in a contraction phase right now, and that we're going to see that a lot of these long holding and leveraged assets. So people that went out really long, there's going to be some real problems. A lot of mortgage funds, like say Canada, let's just focus Canada. A lot of these mortgage funds are going to be a big issue. If they're not very big, they are very specific. They don't have a portfolio of other assets, kind of like SVB. They were very niche, very specific. They just didn't anticipate the risk, and interest rates have gone against them. And they're going to be in trouble with capitalization right now, which also means as that kind of pinches back, it's going to drive asset prices lower. They're going to have to take losses, but it also means a lot of these bigger funds. And when some people put the tinfoil hat on and go, oh, this is time for the huge companies to come in and really, really clean up. And it's going to be very attractive acquisition prices for a lot of like synergistic type of companies. So the BlackRocks, the Goldman Sachs, JP Morgans, these are the ones coming in to bail out SVB. They're going to be looking at all these other smaller ones, and it's going to be a fire sale.
Now they're going to be licking their chops at the opportunity that they're going to have there, right? Like it's like they've got a buffet. It's these big funds with loads of cash and capital deployed. It's a buffet of, all right, what do we want to grab? You mentioned the mortgage kind of back side of things. Another one to look at, and this is an interesting article that I read last week that we're going to dive into on our message board this week. So if you're a subscriber, check out the message board because we'll have some intel on this on there. The automotive industry and car loans is another one that has been kind of flagged as, is there a potential here for this to sort of spiral in a negative direction?
Yes. And I think this sums up what Ray Dalio was saying, was that because it comes to beg the question, it's the question now people are asking is, does the Fed not only stop increasing rates, does it actually drop them, lower them? My guess would be you have to go to zero, no increase, or you ease off. But Ray Dalio has gone the exact opposite. He said it's way too early for the Fed to ease. So that's a bitter pill to take. But he said he's going to be watching closely as he watches for these trade-offs of destruction, price adjustment, acquisitions, and he thinks we're approaching the turning point from the tightening phase into the contraction phase of the short-term credit debt cycle. And so that's it was going to be upsetting for some people because it doesn't mean it's over. It means the pain is now happening. So everyone's gonna be watching very closely. But certainly I'm probably more on his side, thinking it begs the question, is it going to be a zero or is it going to be a quarter point increase? It's going to be interesting to see.
But you're making a good point because kind of regardless of which way the Fed was going to position themselves on this, you're staring down the barrel of some terrible options. Do you jump in and backstop and now you kind of have to adjust on the rates side of things, or do you let it go and then run the risk of whatever happens on the other side? Inflation is going to go massively again. How are you going to combat that? So you're kind of damned if you do, damned if you don't. And there's different theories on how you should handle and approach this, but it's going to be interesting to see what Jerome Powell and his kind of team decide to do. And also then, the knockback effect in Canada and around the world, how are our government's going to respond and look at this and say, what's our best strategy forward? Because it's, like I said, there's not really a great option. You're kind of just having to pick, okay, are we cutting off an arm or are we cutting off a leg?
Yeah, and people ask, what about Canada? What's the risk here? There's always risk. There's always a risk. There hasn't been a bank failure in Canada in 27 years. I haven't gone into depth into the top banks in Canada, but they're pretty well diversified. They're also a lot less aggressive than the U.S. But that being said, we're in very weird times. We're in very strange times. Canada's printed a ton of money. We've got not good employment. It's not a good economy as much as people like to pretend it is. All these jobs that they're adding, they're part-time jobs. We're seeing constant firing on tech, on C-suite, on career jobs, while the increase in your labor jobs, your Tim Hortons, you're having to drive Uber, that's not the switch off of, well, we took 200,000 jobs of C-suite, but we added 200,000 jobs of Uber. That's not the trade-off you want for a country. No. So we're going to be faced with a lot of problems, a lot of issues as this starts. But that being said, Canada's banks are far more conservative than any of these U.S. ones. Yeah,
and there's far fewer of them as well, obviously, given the population size. And I think this is a situation where that is probably a very good thing.
Yes.
And you know, I know Christina Freeland came out and kind of said, look, the risk to Canadian banks is not anywhere close to what it is. And normally when she talks, I kind of go, uh-oh. But I do actually think in this situation, we're in a much stronger kind of base level position now. Is there going to be some pain? I'm sure there could be, but is it going to be to the tune of our Feds having to jump in? Right now, I don't think so.
No, and I mean, some of these, like we said, some of these mortgage-backed funds and some of these kind of mortgage companies, possibly even some of these smaller credit unions type of companies, I don't know what their depository requirements are, the risk that they take. They could be under a lot of scrutiny, a lot of pressure, a lot of problems. But other than that, I think Canada tends to be a lot less aggressive, much more conservative.
Well, look, we've jumped into a lot of this. I know that we've taken a big chunk of time here to kind of dive into it, but it's important, I think, to really kind of get a grasp of the basics and where this is going. And this is, you know, some topics and themes that we want to dive into deeper as well. I mentioned earlier about, you know, we're going to have some analytic stuff on our message board. So stay tuned there. Our subscriber base is growing really nicely. We're very encouraged by that. I know we're going to be doing some more Zoom calls and stuff like that. I'm going to do a budget analysis in the next couple of weeks here when the Canadian government puts out their budget. We'll kind of dive into that and mainly focus on kind of the themes that we talk about, but a general overview as well of what it kind of means. So great content on the message board, on the subscription side of things. Encourage everyone to go there and sign up. This has been great, Andrew. We'll definitely be keeping our eyes on where things might be going in the future. We'll keep an eye on Credit Suisse, and if there's going to be any issues there, what could be the fallback. But thanks everyone for tuning in. As always, hope everyone has a great rest of the week and weekend. Andrew, anything else from you?
No, have a good one, everyone. Take care. We'll talk to you soon.
Take care, guys.